if you were invested in China stocks over the last couple of years, there is a good chance that the performance of these stocks had quite some negative effect on your overall portfolio performance. The Hong Kong Hang Seng Stock Index has delivered negative returns over the last 15 years, and the MSCI China Index even had negative returns of more than 25% since its inception in 2011, and is currently sitting very close to its lowest valuation ever. And these performances were despite a record economic growth over the same time frame. Today, the overall situation seems a lot worse, with numerous economic challenges rising, the real estate bubble popping, and the political situation far from stable. Many people even compare the situation with the Japanese economy that saw almost 2 lost decades of stagnant growth and deflation after its housing bubble popped in the early 1990s. But as our favorite investor Warren Buffett said during the financial crisis in 2008, be fearful when others are greedy, and be greedy when others are fearful. So let's see if the current situation is indeed as bad as it looks, or if now is the right time to be greedy. In today's video, I will have a look at some selected factors that can help you to make an informed decision for or against investment in China stocks. In the end, I will tell you my conclusion of the current situation and also what concrete actions I will take in regards to Chinese stocks. My name is Florian, welcome to Cashflow Maniac. Let's start by looking at the GDP growth of China over the last 45 years. And the general trend here seems to be that the GDP growth is definitely slowing down. Back in the 1980s and 1990s, we can see we had quite a couple of years with a very good double-digit growth of Chinese GDP. Even in the early 2000s, we still had double-digit growth, or at least very close values to double-digit GDP growth. But since then, these values have come down quite a bit, and right now we are currently sitting at the, for China, very low value of around 3%. So the general economic growth in China is definitely quite a bit slower compared to the last at least 20 to 30 years. When we compare the GDP growth forecast between US and China, we can actually see that the GDP of China in the gray bar compared to the US in the blue bar is still on quite a high level. But the forecast over the next years, you can see here we have a forecast until 2028, is decreasing on a year-over-year basis. In the US, we are starting at a much lower valuation of 1.8% GDP growth as of last year. And this year it's also expected to go down a bit. But for the next couple of years, the GDP growth of the US is expected to increase a bit and then stay roughly on the same level. So we can see two vastly different trends here, even though the GDP growth of China starts at a much higher value. While the GDP growth of China is going down, their debt level, government and private, has more than doubled since the financial crisis. And what Baird Asset Management found in their white paper from last October, Investing in China, is that the debt level of the companies in the Bloomberg Large, Middle and Small Cap Index is up by 87% since the end of 2016. At the same time, however, the free cash flow has sharply declined by more than 50%. So there is a real danger here that this excessive level of debt becomes too tough to manage for many companies in this economy that is currently slowing down. This is also reflected in the current very low PE ratios of China. And when we compare this to the other major regions, China, it is actually sitting very close to the lowest level over the last 30 years. The relative valuation compared to the Western market is also on the lowest point of the last 15 years, and when compared to the US, it sits at a discount of more than 50% right now. Statistically speaking, a lower valuation also means a higher expected growth. And what we can see here is basically the forward PE ratios and their subsequent 10-year returns. And we can see here on the y-axis the annualized total returns, and on the y-axis the valuation of the companies. The green bar is the current average level of the S&P 500, but there is a very clear trend that companies with a lower valuation have delivered higher 10-year returns. If these kind of statistics are also interesting for you, I will put a link to my video about the guide to the markets here, where I have a deep dive in many market statistics and correlations. What definitely surprised me a lot is the comparison of the EPS growth of Chinese companies compared to other sectors. And here, the EPS growth of Chinese company is only second to emerging markets ex-China and is about 5% higher than the US and about 10% higher than Europe even. So the companies in China definitely still show some very strong growth. And if we break down the world growth to the different regions, we see that China makes up about 30% of the overall growth in the whole world. So China is the single biggest growth drivers for the whole world. No other country or no other region, even India, contributes more to the current world growth than China does. Many people and investors compare the current situation in China to the situation in Japan in the 1990s. But does this comparison even hold up? In China, the property value peaked at 260% of the Chinese GDP in 2021, after rising from 170% in 2014. In Japan, on the other hand, it actually peaked at 516% of their GDP in 1990, before falling back down to around 400% in 1994. So the property value to GDP was more than double the value in Japan than we have in China right now. The per capita income in China is currently around 20% lower compared to the US levels, and in comparison in Japan, the levels were around 20% higher in 1990, also compared to the US level. So China definitely is at a different stage of the development, and they definitely have some catch-up potential to do here. The structural challenges and circumstances that both of these economies faced are also quite a bit different. And last but not least, China can actually learn from the mistakes that the Japanese government made in 1990. That means a slow and uncoordinated reaction that was too restrictive in the end and resulted in a very strong yen and further eroded the competitiveness of Japan. So China definitely has a different situation, and they also have all tools in hand to avoid a similar situation than Japan in the 1990s. In the Western world, everybody was talking about inflation over the last couple of years. In China, the situation actually was quite the opposite. Here, we currently have a deflation, and the deflation is even increasing in value. That brings a whole new set of problems. When the prices decline, companies earn less and maybe even need to lay off some workers. That means that the unemployment rates rises, the corporate profits plummets. We saw this in the free cash flow of the Chinese companies. And also actually, the more in debt you are, the worse your condition is, because your salary will also most likely decline, while the loan payments remain the same. This actually might become a problem with the current debt levels if the deflation lasts for a longer time period in China. Also, with the layoffs and the unemployment rate rising, consumers are expected to earn less and will also protect their money rather than spending it on consumer products. When we look at the unemployment rates as a percentage of the total labor force, and this is an estimation because the Chinese government also lacks a bit in transparency, and accurate economic data is not always easy to find. The estimation here is that over the last couple of years, you can see since 2017, very roughly, where we had an unemployment rate of around 4%, it has increased quite significantly, and we are sitting well above 5% as of today. When looking at the very long run, the demographic trend of China is actually also quite a bit worrying. We can see from all the regions of the world, we have US, Eurozone, UK and China. The population in China is expected to decrease most out of all these regions. Not only is the population expected to decrease, but the amount of working population, here shown in the gray area, is expected to decrease even faster. Of course, a decrease in population also means a further decrease in workforce, and over the long run, this extreme trend in China will definitely put some pressure on the economy. But we can also see the time frame here, and It is mentioned until 2019, so this is definitely a very long-term and a very slow progressing trend. Nothing to worry about in the next couple of years. All these problems led to foreign investors being very careful when investing in China. And we can see this when we look at the foreign direct investments, the net inflows also as percentage of the GDP to China. And this trend has also decreased very steeply. Please keep in mind, this graph is mentioned as percentage of the GDP, and the GDP over the same time frame has also decreased. So this means that the foreign investments have decreased even quicker than the GDP of China has decreased. As of 2022, these investments were only sitting at 1% of the Chinese GDP. So foreign investors are currently really careful and really afraid when it comes to investments in China. But what does this all mean for our own investment portfolio and our own investment strategy? JP Morgan actually has 2 tips for us here. The first one is more a tactical tip for short-term or swing traders. Here they state that high-quality blue chips are so beaten down that they can recover very quickly and turn the trend around as soon as the market turns. Of course, here at Cashflow Maniac, we are rather looking at the long-term investment trend and we don't do any day trading or swing trading. The second tip is actually more suited for a long-term investor. And here they recommend that we should position ourselves very defensively. They say we should consider solid companies with a strong balance sheet and stable dividend payouts, because we never know when the market will turn and how long it will keep in the same dip as we have right now. So if we have stable dividend payouts, this will definitely sweeten the waiting time until we get price returns again. Sandeep Bihani from East Spring Investments actually recommends a very similar strategy. And here he says that assets become mispriced when investors are either willing to pay a high price for comfort, whilst they still sell unfashionable securities regardless of the value. This kind of bias is systematic, and that is actually exactly the same what Warren Buffett mentioned when he says, be greedy when others are fearful and be fearful when others are greedy. And this can be exploited by long-term investors like us. So he also builds his Asia performance around high conviction stocks where they see a significant dislocation between price and valuation. That means, as JP Morgan, he also looks for very strong companies with a very strong balance sheet and still a good cash flow that are also beaten down and have a very low market valuation compared to their intrinsic valuation. As we just saw, there are many uncertainties in the country that might warrant the current low valuation. Many companies have seen increased debt rates while at the same time experiencing shrinking cash flows. And that alone is already a trend that is very worrisome. But when we combine this with the general and steady decrease of China's GDP, the long-term trend for the economy doesn't seem so rosy. It also doesn't help that the general population in China, and especially the working age population, is shrinking. And the numbers show that this is just the beginning, and the decrease in population will only pick up speed from here and continue over the next decades. On the other hand, the economic growth in China, even though it's slowing down, is still making up a significant portion of the worldwide economic growth, and it will most likely stay that way for the foreseeable future. At the same time, the EPS growth in China is also expected to stay on a very high level, much higher than the EPS growth in the USA or in Europe, at least in 2024, but probably also over the next couple of years. What I didn't mention up to now, and what I also find very hard to estimate, is the political risk when investing in China. With the tension rising between China and the US and China and Taiwan, the situation is far from stable. I think the situation definitely calls for caution when investing. But the investor Munish Pabray also suggests in this book, The Dando Investor, that we should look for investments that are low risk but still have a good valuation due to an environment of increased uncertainty. The general economic environment in China is definitely uncertain, but I also think that the bar to leap over to turn things around from here is fairly low. I also think that the current valuation gives some great opportunities with limited downside risks, And investors who seek some exposure to China or who are trying to diversify their portfolio can definitely benefit from this. In order to be successful, we should be looking to buy companies that are active in a sector with a long-term growth, that have a competitive advantage, and very important in an environment with increased depth and decreased cash flows, have a healthy balance sheet. As the Asia exposure in my own portfolio is also quite low, in fact it is 0, I am looking for interesting opportunities to benefit from the current low valuation and the growth prospects. So next week, I will have a closer look at a couple of Chinese companies that seem interesting, and I'll see if I can find a company that is suitable for my long-term investment portfolio. If you are also interested in investing in China and you want to know what kind of companies I come up with, make sure to hit the like and subscribe button in order not to miss the video. As soon as the video is out, I will also put a link to it right here. That being said, thank you so much for watching, guys, and see you in the next video.